Mayuresh Joshi as well of Angel Broking joins. And Mayuresh, what did you make of those import duty hikes that were announced yesterday? We thought it would give some support to the markets in today's day of trade, but the impact is obvious for all of us to see. The reaction of the index is very soft, and even specific sectors such as aviation, or not, pardon me, consumer durables, footwear are not seeing much of an uptick in trade right now.
Morning, Samina. I think obviously the measures that have got introduced are sentimentally positive, but one must also understand the kind of imports that are coming through, specifically in the segments that the government is targeting. What kind of an overall impact does that have on the CAD? So if it's not a substantial impact on the CAD, it's largely going to be sentimentally positive from a short-term perspective. How these measures play out over the medium term is something to be of reckoning. Having said that, again, I think a lot of these white good manufacturers were facing problems of their own because of the seasonality factor and the unusual torrential rains that we saw during the summer season. A lot of inventory built up had already happened. Couple that up with input cost inflation and the rupee depreciation, I think the margins obviously are getting constrained in a significant manner. So I think a couple of domestic manufacturers, which Piyush was also mentioning, something like an Amber, Dixon, obviously benefit because localization and local manufacturing does go up. But for the AC manufacturers per se, I think anybody who gets impacted, Voltas for example, with their JV and 100% import component coming thereof. Havells has got a significant import component. Blue Star is somewhere in the middle because I think there is significant contribution coming in from imports as well, specifically in terms of raw materials, and the rupee depreciation getting offset in terms of realizations actually getting passed through in terms of price hikes. So I think the local manufacturers, in my opinion, should benefit the most. Other players like Whirlpool, which have got a very significant local contribution and a diverse model as well between refrigerators, washing machines, should also benefit. And large element of that, again, I think the other stocks within the white goods or the consumer durable space should see a sentimental positive move. So from an earnings perspective, it's something like an Amber or a Dixon or something like a Whirlpool.
But Mayuresh, just combined with the negatives that you spoke of in terms of already high inventory build-up because of low demand in the summer season and higher raw material cost, coupled with the fact that regardless of which company it is, there is going to be a price hike across the board, and therefore, is there going to be an impact on festive demand, and then again in the near term another headwind in terms of the upcoming festive season?
So morning Dipanshu, again, yes, as I pointed out, I think the inventory built-up has been quite significant because of the rains witnessed during summer. But a lot of companies and managements in the quarter gone by have pointed out that they should be able to liquidate their inventory in quarter two. As the festive season comes around, quarter three this time round, I do not foresee significant pass-throughs happening because you obviously got to have that demand pent up go through, specifically in terms of managing their inventory. So to that bit, again, I think a partial pass-through will probably come through for what we've probably seen, both in terms of duty hikes, input cost inflation, and the rupee depreciation. So to that bit, I think the margins from a near-term perspective can get squeezed. But to drive the home, to drive the point home, my own sense is that local manufacturers, as I was saying, Amber, Dixon, I think there will be far greater emphasis if these duties continue over a period of time to increase that. And even on the ODM part, which is their original design manufacturing part, they have seen significant traction. So that again becomes margin accretive. For companies like Whirlpool, why I remain positive is because the localization aspect remains extremely strong. So I think they don't get affected to the extent that others might in terms of passing through prices. And again, I think the volume growth has been quite reasonable. So refrigerators is around 57%, washing machines is 21%, ACs are 9%. So it's a diversified model. They've got a very healthy balance sheet, and that can drive earnings momentum. So I'll be selective, as I said, in this space. Amber, Whirlpool probably can be something that can be looked at.
Because this one has come under a fair bit of pressure recently. The management in itself is not very confident of meeting jewelry sales guidance, but there's also the positive aspect of it. There has been no tinkering with duty on gold. Even on the diamond part doesn't affect Titan in a significant way. So is it going to be all the way up for Titan from here onwards? And on Asian Paints, because everything else included, they've been fairly successful in passing on price hikes without any issues. There's a big Goldman Sachs upgrade that's come in on the counter this morning, as well as the target of 1500 plus. Talk to us about these three stocks from the consumption pack. What would your view be?
So Dipanshu, I think looking individually at all these three stocks, again with the duty hikes that you've probably seen on footwear and leather products, again sentimental positive for footwear stocks. For Bata in particular, again, this is something that I've liked. I did mention this stock a few weeks and months back. But a large element in terms of the women's share in terms of their overall pie actually increasing from 30% to 40-45% as per the management guidance augurs well in terms of margin improvement. The second element for Bata also is that they are ramping up their store presence in tier 2, tier C cities. So I think with a very reasonable amount of capex, what they can actually do, ramping up their store presence in tier 2, tier C cities. So I think with a very reasonable amount of capex, what they can actually deliver both in terms of volumes and realizations can be quite substantial. And the third element obviously is the core financials. So our own sense is that a 17-18% top line growth, a 24-25% bottom line growth should reflect very, very positively in terms of their earnings. So yes, I think anybody holding on to Bata should clearly hold on. For Titan, again, I think with no tweaking that is probably happening in duty structure, obviously benefits the company. The company has also put forth that the sales should normalize going forward. So I think the fear on the street in terms of whether they'll be able to deliver that 25% growth on a year-on-year basis is something that has dragged the stock significantly lower. Obviously, I think the unfortunate incidences in Kerala did not help, and that again is going to have a short-term impact on the stock from an earnings perspective. But the third element in terms of even if the company is able to maintain a 20% run rate going forward, with the assumption of maintaining margins because of studded jewelry having a larger say, and the wedding season coming around, I think the sales should normalize, and the balance sheet is very, very healthy. So ROC is in excess of 29%. A cash-rich balance sheet, you can't ask for more. So I think remain positive on Titan. Asian Paints, again, I think it's a classical story in terms of crude oil derivatives moving up significantly, along with rupee depreciation actually denting the kind of margins that the company might report. But you see the whole host of paint companies actually go out with price hikes, and that element of pass-through is something that should ensure that the margins are protected. Now, with the price hikes, do volumes get affected in a significant manner? My own sense is that with new capacities coming up and with repainting demand expected to grow at 1.5 times our GDP, with the assumption of nominal GDP growing at 7.5%, we're probably expected to see volumes stack up between 10 and 11% for the industry as a whole. Asian Paints, obviously a market leader in decorative paints, expected with the new capacities to probably ramp up its volumes as well, pass through prices, protect margins, and again a healthy balance sheet. Valuations might be on the higher side, but again I think if growth comes back, which I feel in the second half and sustains, my own sense is that the valuation premiums might get justified. So anybody holding on to Asian Paints should hold on.
Mayuresh, closing comments. What's the sense on the markets right now? 800-point retracement, very swift. What's the sentiment like, especially in your dealing rooms? And of course, going forward from here, is this a buy on dip kind of a market, or do you think it's more of a sell on a rally kind of sentiment right now?
So Dipanshu, again, I think with all the news surrounding macros and what you've probably seen with crude and the rupee depreciation and what is happening with the NBFC universe in terms of liquidity concerns surrounding it, the Fed rate hikes, expectations of RBI hikes, what happens with the CAD, I think all these factors probably have resulted in a very sharp price-wise correction for the markets. Now my own sense is that the markets will now try to gauge all these developments and what probably happens over the next few weeks. So we might enter into a time-wise correction over the next few weeks and months. But as the festive season comes around and as the result season starts coming around, my own sense is that it will start getting focus back in terms of core earnings, because that is where the entire premise for the markets lie. The second element obviously is going to be the range for the market. So I think the markets, as I said, might get into a time-wise correction. Do not see a significant correction from the current levels. And again, I think a lot of measures that are proactively coming through, whether it's from the central bank, which announced liquidity measures in the morning today, the government, which also has a close eye in terms of keeping its fiscal and current balances in check, as well as I think the global regulators who are also keeping a very close eye in terms of capital market and risk assets in general. So my own sense is that it has to be a bottom-up approach. I think there have been a significant correction in small caps, mid caps. So I think quality is something that should hold out. And the qualitative names across segments, whether it's autos, NBFCs, select banks from the private universe, consumption, FMCG, consumer durables, white goods as I mentioned, select cement names, I think they've corrected quite significantly. So I think a staggered way of investing into these qualitative stocks is something that I would suggest, because over a period of time, leaving the short-term pain for Q2, Q3, earnings should normalize, they should come back to their mean in terms of earnings estimates. And again, I think with earnings expected to improve, I think FY20 is going to be a blockbuster year from India Inc.'s perspective. So yes, I think remain positive on the markets, but one should expect a time-wise correction to enter these markets over the next few weeks.
All right, time-wise correction and then possibly an entry point there in the market.
That we'll take a break. We'll come back and continue our conversation and focus on the markets. We'll connect with the manager of Blue Star.